Okay, so here is a fun paradox to start us off. You hit a record $8 billion backlog, but your free cash flow randomly plummets 40% in a single quarter. That is the story for Cadence Design Systems today. It is April 27th, 2026, and you are listening to Earnings Unscripted. We are digging into their Q1 numbers, ticker CDNS. And just a quick disclaimer, we are just two friends analyzing markets, so this is definitely not financial advice. So, Miro, top line grew a bit to $1.47 billion, but GAAP earnings are down to $1.23 a share. What is actually going on under the hood here?
They finally swallowed Hexagon. That is the short answer. Look, Cadence closed their massive acquisition of Hexagon D&E, and paying for that, well, it takes a heavy toll. They dropped roughly $1.6 billion in cash, and obviously you lose the interest income on that pile of money. Plus, you have all the acquisition integration costs kicking in right away.
Right, which totally explains why the margins compressed. Non-GAAP operating margin came in at 44.7%, so down about 110 basis points from last quarter. It seems like the market algorithms completely panicked right at the bell because the stock was swinging all over the place.
Oh yeah, it was highly erratic and extended hours. It dropped, it spiked, completely chaotic. But then, as the earnings call actually played out, people started listening to the context. The patient money walked the stock back up. It ended the extended session positive, up around 2.2%. I think investors realize the core business is actually accelerating, especially on the hardware side.
Yeah, the hardware side is super fascinating right now, especially with this whole physical AI push. They actually had NVIDIA's CEO Jensen Huang autograph the front of their new Millennium server box at a developer event recently, which is just, I don't know, the ultimate nerd flex.
It is absolutely a flex, but it proves the underlying point. Automotive OEMs and robotics companies are pulling these physical worlds timelines way forward because they need to simulate physical worlds, not just text models. But I actually want to go back to that free cash flow number. That 40% drop you mentioned is mostly an optical illusion.
Wait, an illusion? Okay, let's get into the details on that then, because on paper, a cash flow hit like that looks pretty alarming.
Yeah, it really is. If you just screen the top line numbers, you see operating cash flow drop to $356 million. That is a 36% hit. But they essentially shoved roughly $180 million of pre-close Hexagon tax liabilities into that operating bucket.
Okay, wait, so economically, that is just part of the price of buying the company.
Exactly. It is basically purchase consideration. But because of how the accounting rules work, it lands in operating cash flow instead of, investing activities. If you pull that back out, their actual operational cash flow generation is closer to $536 million.
Right, which actually puts them ahead of their own organic guide. So the basic screening algorithms punish them for a structural accounting quirk?
Bingo! Basic screeners miss this entirely. Now, the integration cost is absolutely real in other places. I mean, their headcount exploded. They added over 1,300 employees in a single quarter.
Wow.
Yeah, a 9% spike in 3 months.
Software companies do not typically hire 9% of their workforce in one quarter, unless they're just absorbing a massive acquisition team whole.
Yeah, true. So R&D and SG&A are going to be very heavy. But honestly, the cash flow noise is a distraction compared to what they are doing with their software licensing. That is the real insight here.
You mean the agentic AI pricing shift? Because I was looking at that and it feels like a total Trojan horse.
It is incredibly smart. Historically, electronic design automation, or EDA, is flat recurring revenue. You buy a seat, a license, and a human engineer uses it. But Anirudh Devgan, the CEO, made a comment on the call that changes the entire math of how they make money.
Oh, right. I actually have the transcript right here. Let me read this. He said, one engineer will run like 1 or 2 experiments. When the agent runs those blocks, they may try 10 or 100 variations. And then he noted it inherently runs more of the base tool.
Stop right there. 10 or 100 variations. A human engineer runs out of time or just, patience after 2 tries. An AI agent does not care. It will quietly spin up 100 iterations in the background. But here is the critical part. Devgan explicitly said they are moving to a, quote, subscription plus consumption model.
There it is, the utility meter.
Exactly. They are quietly turning flat software into a utility bill. If an AI agent tests 100 variables instead of 2, it pulls Cadence's simulation tools 50 times as often. You are now paying for that raw compute consumption.
Geez. It is just a wildly elegant way to multiply revenue without needing to sell more human seats. You just let the AI run wild. But how do customers absorb that? Do they push back?
Well, they kind of have to pay it, because if your competitor's AI agent just tested 100 node layouts overnight and you only tested 2 manually, you lose the chip design race. It is a pure arms race, and Cadence is just leasing the testing ground.
Which explains why their R&D mix is shifting, right? I saw they noted EDA used to be 7% of R&D, and now it's closer to 11%.
And management thinks it goes even higher.
Because the software is not just a digital drafting board anymore. It's essentially doing the engineering itself.
Exactly.
Okay, so bringing this all together, we have optical illusions dragging down cash flow, a massive influx of Hexagon headcount, but under the hood, a quiet, highly lucrative shift toward consumption billing.
Basically, yes. On paper, it's a messy integration quarter. Structurally, the engine is revving higher than ever.
Right. Okay, so where does this leave them heading into the rest of the year? Because management definitely shifted their tone on the full year outlook.
Well, they basically doubled down on optimism. They actually raised their full-year revenue target. The new guide is roughly 6.1 to 6.2 billion. So that is around 17% growth at the midpoint.
Wait, 17% top-line growth while actively swallowing a massive integration? That is, I guess that explains why they brought up targeting the rule of 60 for the first time.
Right. Revenue growth plus non-GAAP operating margin. It is the holy grail metric for SaaS companies. But look, it comes with a fairly big asterisk. The CFO, John Wall, was blunt that 2026 is fundamentally an integration year. They are absorbing a 28-cent EPS headwind just from foregone interest and acquisition costs.
Sure, but the long-term vision is doing a lot of heavy lifting there to keep investors calm. You eat the pain today because Anirudh Devgan clearly believes physical AI is the real gold rush. If he is right about robotics and automotive testing being a larger market than standard data center AI, that Hexagon deal is actually brilliant.
If he is right, yes, it opens an enormous addressable market. My one open question here is the renewal cycle. Management openly admitted 2026 is a technically lighter year for their existing multi-year software contract.
True. Although they do have that record $8 billion backlog, does that not provide a pretty massive safety net?
It does. The backlog gives them incredible visibility. I was going to say, actually, I think the real friction point to watch is how clients react to the new consumption pricing. If engineering firms push back on paying a toll for every single AI trial, that rule of 60 dream might get delayed.
Well, the house usually finds a way to collect its toll. But yeah, we will see if the market blinks next quarter.
They usually do.
Fair enough. Okay. We should wrap this up before you get too cynical on us. Thank you all so much for hanging out and unpacking Cadence with us today. Catch you after the next earnings call.
Take care, everyone.
If you like making sense of earnings without the usual corporate fluff, you might want to hit follow so the next episode just drops right into your feed. We do use a little AI assistance behind the scenes to quickly pull exact quotes from those dense SEC filings, but the conversation itself is built strictly for human ears. We would love to hear what company you want us to unpack next, so drop a ticker to earningsunscripted@datamadness.ca. Or find the X link in the show notes.
See you next time.